Right. Hi, good morning, everyone. Welcome to today's webinar on the principles of technical analysis. All right. We've already done a sound check before starting this webinar, but just so I can make sure, all right, can you guys just let me know in the questions tab if you guys can see my screen, all right, see the slides on the principles of technical analysis and can hear my voice. All right, if you can hear me and you can see my screen, could you just drop a yes in the questions tab? Don't be shy, just drop a yes in the questions tab so I know you can see me and hear me. Okay, all right, that's great. All right, thanks, Cheng. All right. Okay, that's great. You guys can hear me, you guys can see me. All right, what we're gonna do is we're just going to wait for about 2 to 3 more minutes. All right, we're gonna let the rest of the crowd stream in. All right, so let's just give me about 2 to 3 more minutes. All right, we'll just wait for the rest of the attendees to stream in, and then we can start on today's webinar on the technical analyst approach. Okay, looks like everyone is just about here. All right, we have a couple more people joining us. All right, so could you guys, if you guys are just joining us, all right, if you guys can hear me and see my slides, all right, could you just drop a yes in the questions tab? All right, just a quick one before we start on today's webinar. All right, if you can hear me and you can see my slides, just drop a yes in the questions tab below. All right, thanks, Xing Yu. All right. Okay, that's great. All right, we can start on today's webinar on technical analysis and the principles of technical analysis. Okay. All right. So for today, all right, today we'll be going through the principles of technical analysis. All right. Before I start, all right, this just a quick introduction. All right, my name is Don. I'm from Everest Fortune Group, and in partnership with XM, I'll be presenting these Tradepedia webinars to give you some education on forex and forex trading on Tuesdays and Thursdays. All right, and for today's topic is on the principles of technical analysis. All right, the technical analyst approach to looking at the markets. All right, so today this is on technical analysis. If you guys were here last Thursday, all right, I was giving the webinar on fundamental analysis. All right, the fundamental analyst approach to trading and to looking at the markets. All right, and this is the other side of it. All right, the other form, all right, big form of analysis that many traders, many analysts use. All right, to look at the markets, and that's technical analysis. All right. And in this webinar, you'll be learning what is technical analysis. All right. What's this thing that lots of people like to talk about? All right. You'll also be learning the principles of technical analysis. All right. What are the basic principles, and what are the advantages of technical analysis? Why so many people are attracted to this style of analysis? All right. And also some criticisms of technical analysis. Why there are some naysayers? There are people that think that technical analysis shouldn't be used at all. And of course, me myself being someone that uses a lot of technical analysis, I'll provide some rebuttals to that as well. All right, but it's important to know there are criticisms of technical analysis, very popular criticisms as well. All right, and finally, we'll be going through a bit of the Dow theory. All right, the Dow theory is basically what the most basic form of technical analysis. All right, the founding father of technical analysis, Mr. Charles Dow, came up with the Dow theory, and we'll be going through that in a little bit near the end of the webinar. All right, so the way the webinar will be conducted, all right, I like to keep it more interactive. All right, I see a lot of new names. All right, I see a couple of new names in the attendees. All right, so if you guys have any questions, all right, feel free to just drop them in the little questions tab that you can see on your GoToWebinar. All right, you can see the questions tab there. If you guys have any questions at all, just feel free to drop me a question anytime. All right, anytime during the webinar. There's no need to raise hands or anything. Just drop me a quick question, and I will see if I will answer those questions for you. All right. So without further ado, let's start on today's webinar on what is technical analysis, the principles of technical analysis. Right. What exactly is technical analysis? Right. Basically, technical analysis is the study of market action, right? Mainly through the use of charts for the purpose of forecasting future price trends. All right. That's the textbook definition, what technical analysis is. All right. You might have heard of technical analysis being called charting as well. All right. Charting. So basically what technical analysts do, we basically look at price charts. All right, we look at market action, price action, and under the belief, all right, the concept that the past tends to repeat itself. All right, and history tends to repeat itself. All right, we can use previous data, previous price action, market action data to forecast future price trends. All right, and that's really interesting, right? You're basically looking at the past, projecting into the future. You want to have an understanding of how the market could perform in the future based on how it has performed in the past. All right, pretty simple concept, right? And there are many ways of looking at the market in that way. All right, so what is technical analysis based on? What, right? It's basic principles. What is it founded upon? All right, well, it's based on three very simple, very key principles. Number one, all right, number one, it is that the market action discounts everything. All right, number two, it is that prices tend to move in trends. All right, prices tend to trend, whether it's an uptrend, a downtrend, or if it's just ranging. All right, prices tend to move in trends. All right, and thirdly, all right, it is that history repeats itself. All right, I've spoken about this before in the definition. All right, history tends to repeat itself, and because of that, we can use the past and project it into the future. All right, pretty simple. All right, pretty simple. Three basic principles of technical analysis. We'll take a look at them one by one. All right, so you understand what is the foundation of technical analysis. All right, so let's dive into the first principle of technical analysis, which is that market action discounts everything. All right, what does that mean exactly? All right, what does that mean when I say market action discounts everything? All right, this means that basically the price reflects all available information in the market. So if you were here for the Thursday webinar, all right, when I was talking about fundamentals, you know about all these different factors that could affect the price of a certain asset class, whether it's stocks, bonds, commodities, all right, currencies also, all right, all these different asset classes, their price are affected by different factors, all right, whether it's economic factors, political factors, all right, different factors, all right, that can affect the price of that asset class, right? Basically, what technical analysis says is that the price has already factored in all these factors. So there's no need to go and nitpick and check on all the different things that could affect these factors and then in turn affect price, because price has already factored it in. All right, you see the price as it is because it has already factored in all these factors into the price. All right. So the price also includes like the hidden fundamentals, all right? The fundamentals that you might not know about, all right? All these events, okay? So the price has already factored all of that inside it, right? Everything that affects a share, we call them the fundamentals, and fundamentals are all reflected in price. So for a technical analyst, all right, for a technical analyst, if prices are rising, it means that the fundamentals must be good, meaning demand is greater than supply, all right, regardless of what the news could tell you or what different events might tell you, all right. If prices are rising, technical analyst just says demand is greater than supply. That means the fundamentals are good, all right. No question about that, all right. And on the flip side, if prices are falling, it just means that supply is greater than demand, all right, which means that the fundamentals must be bad, all right, regardless of whatever is being said in the news, all right, whatever you read in the newspapers, whatever you read on different sites, CNBC, Bloomberg, whatever they say, all right, a technical analyst would just look at price. If prices are falling, it means that fundamentals are bad, supply is greater than demand. Prices are rising, it just means that fundamentals are good, all right, demand is greater than supply, right? Simple as that, because we just look at price action and we just the basic concept is that the price has already factored everything in. Market action discounts everything, all the fundamentals, and hence the rumor, hence the saying, hence the saying, you buy the rumor and you sell the fact, right? It's basically because of this, because the market action will have discounted everything. Okay. The second principle, all right, is that prices tend to move in trends, all right? And you can have different trends, okay? So this principle actually originates from Dow's theory, which we will be going through nearer to the end of the webinar, all right? The Dow theory and its 6 basic principles. All right, so one of the basic principles, this principle on prices moving in trends, all right, it originates from Dow's theory, which says that prices move in zigzags rather than straight lines, all right. Mr. Charles Dow basically concluded that prices move in zigzags instead of straight lines, and that creates 3 directions, which is an uptrend where the general movement is up, right? If you can see, there are clear zigzags, all right. And how do we know that it's an uptrend? Right? If you look at it just like that, all right, it's really clear that it's an uptrend, right? From where price started to where price ended, it actually rose, okay? But because of the zigzag movement, you can clearly pick out the market action in the market, all right? You can clearly see the market action through the price when it starts to make higher highs and higher lows, all right? And because of that, high highs and high lows form those zigzags that Mr. Charles Dow talks about in his Dow's theory, and that forms an uptrend, all right? Other than an uptrend, we have a downtrend, and it's just the flip side, right? Take a look at it again. It's pretty obvious that price is actually falling from where it started to where it ended. All right, price is actually falling. All right, and you can look at the zigzag. All right, you look at the price action as it is falling. All right, you can see that it's making lower highs and lower lows, thereby forming that zigzag, which lets you know, okay, price is in a downtrend, right? So other than uptrend and a downtrend, there's also the range. All right, the range is where price is basically not going anywhere at all. All right, it's just ranging between, I guess you could see it as 2 barriers at the top and at the bottom. All right, so where price was at the start and where price eventually ended up is basically about the same. All right, there are no higher highs, no higher lows. All right, there are no lower highs and no lower lows. So there's no uptrend, there is no downtrend. Price is just ranging, all right? So price could move in that kind of a trend as well. It's just ranging, all right? It's going sideways, as we like to say. Market is just going sideways, all right? So that's when price is ranging. So these are the 3 basic market movements, and it makes sense, right? If price is somewhere, all right, you basically, there's only 3 ways that it could go. It could either go up, it could either go down, or it could either stay right where it is. All right, so if it's going up, it's in an uptrend. You characterize it by the higher highs and higher lows, all right, and you start to see that zigzag movement up. If it's in a downtrend, it's the flip side. You see the zigzag movement down, you know it's in a downtrend. And if you see the zigzag movement is just going sideways, then you know that price is in a range. All right, so that's the basis of what we mean by prices move in trends. All right, and the last part, all right, is that history repeats itself. All right, history tends to repeat itself because investors' behavior tends to repeat itself over time. All right, who are the market participants? All right, who participates in the market is us, right? It is humans, all right? And the way that humans behave tend to be very, very predictable over time, all right? So this behavior tends to create identifiable price patterns, which can be studied, and then you can use them to predict similar future patterns in the future, all right? Because it doesn't change, all right? It's not like someone just comes in one day and takes the human factor out of the market immediately, all right? Whoever the people, those that are participating in the market are generally people, all right? Even if you say computers, all right, are trading for us, all right? Algorithmic trading, they are based on the humans that write the code behind it as well, all right? So investors' behavior tend to repeat over a period of time, and that's why that you can basically use previous price action and project it into the future. All right, and you can see history kind of repeat itself over and over again, and these price patterns tend to repeat itself over and over again. All right, and it creates very identifiable price patterns, like the very popular head and shoulders pattern, for example, is a very clear reversal pattern. All right, that happens at market tops, or the inverse head and shoulders for the market bottoms. All right, these are identifiable price patterns that can be studied, and why it happens is because investors' behavior are just repeating. All right, so why is it that humans, all right, tend to have very predictable behavior? Because we are governed by two basic emotions, which are greed and fear, and they have been shown to keep showing up at market tops and market bottoms. All right, this is because human psychology, all right, does not change. All right, as I said, you cannot just pick and pluck out the human factor out of the market. It's going to be there as long as humans are in the market. All right. So this is why these patterns tend to work in the past, and then they will tend to work in the future as well. All right. It's a pretty simple concept. All right. History repeats itself. All right. It's not something new that will happen. All right. Of course, there are unique moments in the market, and of course, when that happens, you can study it again, and then when it happens again in the future, it's kind of predictable. All right, because investors' behavior are generally repetitive. All right, we are very predictable animals. Okay, so these are the three basic principles of technical analysis. All right, and what they are founded upon. All right, and the next part I'll be going through with you. What are some of the advantages of technical analysis? All right, what are some good things about technical analysis, and why people like myself are more drawn to using technical analysis as a very clear foundation for how to look at the markets. All right, technical analysis, basically it is flexible, it is also adaptable. All right, it applies to many different trading mediums. All right, technical analysis applies to many different trading mediums, it applies to many different time dimensions. All right, and it plays a role in economic forecasting. All right, it's not just fundamental analysis that can help to forecast the economy. All right, so these are some advantages of technical analysis. I'll go through them with you guys one by one. Okay, so flexibility and adaptability. What do I mean by that? All right, so basically what I mean by that is that technical analysts or chartists, we basically can easily follow markets as desired. All right, which is not true of fundamentalists, who tend to be more specific in the field that they are good in. All right, so for example, someone who's very good at looking fundamentals for stocks, all right, that's not very transferable in terms of looking at the fundamentals of currencies, for example, or commodities. Right, it's not a very transferable skill. Whereas chartists or technical analysts, all right, what we're doing is we're basically looking at price. All right, we're just looking at price and price charts. And regardless of whether you are looking at stocks, or you're looking at commodities, you're looking at gold, silver, uh, or you're looking at currencies, all right, all these have price charts, and they're generally the same. All right, so chartists can easily follow these markets, and they can follow as many markets as desired. All right, you want to look at stocks, you look at a stocks price chart. You want to look at currencies, you look at forex price charts as well. All right, what's good about that is that technicians can rotate their attention and capital in order to take advantage of the rotational nature of markets. So you know that the market goes through a cycle. All right, in some parts of the cycle, certain asset classes do better than other asset classes. All right, and say for example the economy is booming. All right, a certain asset class, like for example stocks, more risk on asset, might be performing better than another asset class that's more risk off. Say for example let's say like gold, for example, a safe haven asset might not be looking as good in an economy that's booming, right? Well, technicians can just rotate their attention to look at asset classes that are looking better, all right? Because they're just looking at the price chart of that asset class. Whereas if you're looking at just fundamentals, all right, you might not be able to rotate your attention to take advantage of this rotational nature as well. All right, so that's the good thing about technical analysis. All right, you can be very flexible across many asset classes that you look at. All right, so a trending phase is usually followed by a trendless period, and while at the same time, another market will be experiencing a new major trend or a new trending phase. Right, so when this rotational nature of the market happens, you don't want to be caught in that trendless period. All right, what technicians can do is just basically shift their attention to another asset class. It's as simple as that. Right, so that's the good thing about technical analysis, right? You can take advantage of that rotational nature of the market. Okay, all right, another good thing about technical analysis is different trading mediums. All right, spoken about this. All right, is because it is based on the study of price action, and everything has price action, right? Stocks has a price. All right, different stocks are trading at a price. All right, gold is trading at a price. Oil is trading at a price. All right, all these different trading mediums, they all have a price, and because we only look at price action, technical analysis, you can apply it to different trading mediums. You can use it to analyze stocks or equities. You can use it in commodities like gold, silver, oil, copper. All right. You can use it in foreign exchange, forex, or currencies. All right. Or you can even use it in bonds and many other assets like derivatives. Like for example, all right, crypto is a very new asset class, right? All right, cryptocurrencies are a very new asset class, but they're still trading with a price, right? So you can look at a crypto price chart and apply technical analysis to it as well, all right? Because that's basically how you want to look at that market. You're just looking at the price action, right? And that's the good thing about technical analysis. You can rotate across different trading mediums, all right? And also you can rotate across different time dimensions as well, right? Technical analysis is not, you can just look at, let's say you're a day trader, then you just look at 4-hour and a 1-hour chart, all right? If you don't want to do that, right? If you don't want to do that, you can apply it to different intraday timeframes, or even up to weekly or monthly timeframes, and that just suits your trading style, right? So short-term traders tend to look at hourly charts. 1-hour charts, 4-hour charts are very popular timeframes. All right, medium-term traders, they look at daily charts, right? Daily, basically one candle is formed in that day, right? That's a daily chart. And long-term traders can look at the weekly charts, right? Weekly charts, or even up to monthly charts as well, right? So the opinion that technical analysis should only be used for the short term is not true at all. All right, it's not true at all. I myself also use a range of different time dimensions. All right, from the weekly, the monthly, all the way down to the 1 hour to 4 hours. All right, so you can apply technical analysis across many different time dimensions, and it's all dependent on your trading style. All right, if you are more of a swing trader, you want to take more long-term positions, then you could look on the monthly chart, the weekly charts, the daily charts. All right, if you are just you want to be trading within the day, intraday trader or day trader, you can just look the daily charts, hourly charts, all right, 4-hour charts. These are very useful. If you're a scalper, you'll be going down even lower, right? 1 hour, 30 minutes, all right, down to even 15 minutes, 5 minutes as well. Okay, so these are the different time frames that you can trade in. Why? Because in these different time dimensions, all right, you have price data for each of these time dimensions. All right, so if you're on a daily chart, each candle represents a day's worth of price action. All right, if you're on like a 5-minute chart, every 5 minutes you get a new candlestick to look at. All right, so it's all dependent on your trading style. It's very customizable in a sense, because you can look at it across different time dimensions. Okay, so it's not just that technical analysis. All right, it's pretty much only useful for the shorter time frame. Of course, if you're looking on a longer time frame, all right, like say the daily, the weekly, the monthly, then the price could be affected by all these different events that could be happening. All right, like for example, last Friday was the non-farm payroll. All right, if you're just looking on the technical side of things, you might get swing. All right, the market might swing. All right, the market might whipsaw during these times when there's very important news coming out, high impact news as we call them. All right, so if you're on a higher time frame, you also need to take note of these different kinds of fundamentals that could affect the market sentiment. It could affect the price action and how volatile the market will be during that time. All right, but as a general rule of thumb, if you've considered that, you could still use technical analysis across different time dimensions. Okay, so that's another of the advantage of technical analysis. Okay, so finally, the last part on economic forecasting. All right, economic forecasting. Technical analysis can be useful in that sense as well. All right, for example, the charts of commodities like the price of gold or oil. All right, it can indicate the strength or the weakness of the economy as well as the direction of inflation. All right, is the rate of inflation going to be increasing or decreasing? All right, price charts of commodities can give you some clues. All right, give you some clues about how the economy might be doing might be doing at that particular period of time or how it could be performing in the future. Right. So for example, rising commodity prices tend to suggest a stronger economy, all right, because there's more demand for commodities, sorry. There's more demand for commodities. That's why the commodity prices rise, all right. And more demand for commodities generally mean that people are looking to produce more, all right. Producing more generally means high economic growth, all right. You can look at it as a very simple way like that. All right. So rising commodity prices, it could suggest a stronger economy. It could suggest rise in inflation as well. Whereas a falling commodity prices, they tend to warn that, okay, the economy could be slowing down. All right, there could be a drop in inflation. Okay, another way that you can take a look at the price of asset classes and relate them to the economy is take a look at interest rates and how they are generally positively correlated with commodity prices and inflation, and they tend to be inversely correlated with bonds. All right, so uh, I've talked about interest rates and inflation and all these things, the fundamental factors that could affect price. All right, but you could also look at commodity prices, all right, and see how they are related with interest rates as well. All right, so the price of commodities, all right, price of bonds as well, all right, they could be used to get an earlier idea, all right, an early clue as to how the economy could be performing even before interest rates reports are released. Okay, another thing you could look at is the US dollar. All right, the US dollar is a very widely used currency, right? And the US dollar and other currency futures also can help to provide early guidance about the strength or the weakness of that respective economy, right? So a lot of people look at the US dollar because it is a very widely used currency, all right? So the US dollar gives an idea about how the US economy is performing, and by extension, it also gives us an idea of how the general world economy is doing as well. All right, so you could look at the price of US dollar, you could look at other different currencies or currency futures to have an understanding of what is at least the understanding of what is the market sentiment today. What is the sentiment like for the market today? All right, so that's how you can look at prices to get an idea of economic forecasting. Okay, so I've talked a lot about the advantages, all right, the great parts about technical analysis, all right. Why is it so great and why so many people like to look at price charts, like to subscribe to technical analysis? But of course, there are also criticisms of technical analysis, all right. There are also people that look at technical analysis and they don't believe in what it teaches, all right. So why is that? Why do people criticize technical analysis? What are some popular criticisms? First of all, it's that it's a self-fulfilling prophecy. Also that they believe that the past cannot predict the future. All right. And some people quote very core concepts that basically go against the principles of technical analysis. Some of them are that the efficient market hypothesis and the random walk theory. And what are all these criticisms? All right, let's take a look at them. All right, the first one, very popular, is that technical analysis is basically a self-fulfilling prophecy. What do I mean by that? So let's take a look at an example. All right, so what it means is that using price patterns, all right, to predict how price could move in the future. All right, it's very publicized. So for example, let's look at the head and shoulders pattern. All right, you can see this kind of formation occurring in the market. All right, so you have your left shoulder, then your head, then your right shoulder. You can see, oh, it looks like a head and shoulder is coming in. A lot of people, all right, definitely lots of people will be in the market looking at this and being and understanding, okay, it's a head and shoulder, it's a reversal pattern, all right. And because of the way that people can see these patterns, all right, what happens, all right, what people think tends to happen is that because they are familiar, because they know that after this pattern occurs, it tends to result in a reversal, all right, traders tend to act on the same signals, all right, they act on this signal. So for example, if it's a head and shoulder, you know that it's going to, a price is going to start tanking from there, all right, what do? You sell, right? You want to trade with that trend. What happens is when people start to sell off once the formation happens, all right, what people think of the pattern is that this pattern is just a self-fulfilling prophecy, all right. What you're doing is you're just seeing this happen, all right, and once people start to sell, of course the supply will be greater than demand, and of course uh, price will start to tank from there. But it's not tanking because of basically a concept, all right, because of a simple concept, all right, a concept that's rooted in logic, all right. It's basically tanking because people see a price pattern occur, they start to act on it, and all right, you tend to have a self-fulfilling prophecy, all right. It just starts to tank because people see the pattern appear, not because the pattern is indicative of anything at all right. So this creates that self-fulfilling prophecy, all right. All right, although the first reaction, all right, technicians tend to debunk that myth by confirming that they only trade after the completion of that pattern. All right, so the pattern needs to be completed, and if you understand how the head and shoulders forms, all right, you only tend to trade after the pattern is completed, which means you don't try to short it at the right shoulder. All right, you tend to short it only after price has broken below the neckline, and you are sure that, okay, the head and shoulders has formed, all right, because it has formed, I'm pretty sure that price, all right, the market is trying to give me a clue, all right, that's where I will start to short it from, all right, because you're getting that sell signal after it has broken the neckline. Okay, so they only trade after the completion of the pattern. So markets are driven by supply demand, and technicians actions tend to only distort them temporarily. All right, what they're saying is that we don't create this pattern. All right, the pattern doesn't occur because, oh, the head has formed, let's start to short all the way to the neckline, and then we buy to make that right shoulder, and then we short it again. All right, it doesn't happen that way. All right, how technicians tend, very classical technical analysts tend to look at it is they want to see that break of the neckline first before they start to short it to the downside, right? Because it's not them, right? It's not them that's making this pattern appear in the market. Okay. So another thing that they tend to say is that how many people use technical analysis? All right, there are tons of traders out there, and not every single one of them uses technical analysis exclusively. All right, so you don't know whether it's maybe 30% of the market using technical analysis and they see the head and shoulders and they start short, or is it 70% of people in the market using technical analysis, they see the head and shoulders, okay, let's short it from there. All right, so you don't know what is the proportion of the market that uses technical analysis and looking at these price patterns having formed exclusively and trading exclusively on that, right? So that's the sort of technician's rebuttal to this self-fulfilling prophecy. All right, we don't create this pattern. All right, we only trade after the pattern has been completed, and it has shown in the past that once the head and shoulders form, break up the neckline, all right, sometimes it makes a tiny pullback before pushing much lower. Okay, so that is the self-fulfilling prophecy argument, and that's the technician's sort of rebuttal to it. Okay, so that's the first criticism, very popular one. All right, second one is that the past cannot predict the future. All right, this is what people tend to say. Can the past predict the future? All right, some people don't believe so. All right, critics of technical analysis often raise this question. All right, just because it has happened in the past doesn't mean that it is going to happen in the future. Okay, but what we tend to see is that in every statistical analysis, all right, the past is used to predict the future. All right, this is true for economics or fundamental and technical analysis. Okay, it's true. All right, it's true that the past can be used to predict the future. All right, so analysts can only estimate the future by projecting past experiences into the future, and the use of past price data to predict the future, right, is based on sound statistical concepts. All right, so what other data can you look at? All right, even if you're looking at fundamentals, all right, you're still looking at how these fundamentals, how have they affected the market in the past, and then you're using that to project into the future. All right, so this applies across different kinds of analysis, not just technical analysis. All right, so that's sort of a technician's rebuttal to when people say, well, how do you know that the past can predict the future? Right? It's used in all different kinds of analysis. All right. So some people also quote the efficient market hypothesis. All right, they quote the efficient market hypothesis to sort of rebut technical analysis. All right, what is the efficient market hypothesis? It basically holds that uh, it's basically saying that prices tend to fluctuate randomly about their intrinsic value. All right, and it's also saying that what is the best strategy? It's not to sort of time the market, all right, to pick out the market tops and bottoms. Basically, what you're doing is you just buy and you hold. All right, if the fundamentals are solid, you don't care about the price action. All right, you just buy and you hold, and eventually price will reflect the intrinsic value of that particular asset that you're holding. All right, and if you are right, the price will eventually reach that higher price that you're looking at. All right, if your analysis is correct, that's what will happen. All right, so this is they advocate for a very simple buy and hold strategy and waiting until price reaches that intrinsic value of the asset class. All right, in it, as opposed to trying to beat the market. All right, trying to find reversal patterns that you can help you to pick out the market tops and bottom. All right, this controversial theory it basically assumes that existing prices already incorporate the news and data that comes to everyone at the same time, and that's why no one can take advantage of it. All right, no one can take advantage of the different news. All right, the different fundamentals. All right, but you got to realize that that's also what is the basis of technical forecasting. All right, important market information is discounted in market price. All right, long before it becomes known, and not just fundamentals that everyone knows about. All right, technical analysis basically advocates for the fact that the price has already accounted for all the fundamentals, all right, including hidden fundamentals that people might not be able to see or see in time to make good judgments about the particular asset class that they're looking at, right? So that is the basis of technical analysis, all right? So it's not enough to just say, all right, you just buy and hold and you don't look at price. When for a technical analyst, all right, the price is indicative of fundamentals as well, right? It has already factored it in. So price is a very big factor in a technical analyst book because it has already factored everything in. All right, that's why a lot of technical analysts like to say that price action is king. All right, price action is king. You want to look at price action before anything else. Okay, there's also another theory called the random walk theory. All right, what the random walk theory claims is that price changes are like quote unquote serially independent. All right, and price history is not a reliable indicator of future price action. And put it in simple terms, what it basically means is that price movement is random. All right, it's unpredictable. All right, it's a random price movement. All right, and I'm sure some of you will have heard that because of the random walk theory, all right, a blindfolded monkey throwing darts at a piece of paper with different stocks on it, and then you just buy the stocks that the monkey throws the darts and hits it, would perform better than a professional analyst or a professional portfolio manager picking and choosing stocks based on his analysis. All right, because of that, you guys would have heard of that example as a possible supporter of the random walk theory. All right, price movement is random, it's unpredictable, and that's why a blindfolded monkey throwing darts is probably going to perform better than the professional portfolio managers that manage your positions and all that. All right, so it is true that all markets tend to exhibit a certain amount of randomness. We call this noise, all right? And I find that noise tends to appear more as you zoom in on the lower time frames, all right, like 5 minutes, all right, 1 minute, this kind of time frames, all right. There's a lot of noise, All right, but to believe that all price movement is random tends to be a little bit unrealistic. All right, and price movement being very random tends to be for those that have not taken the time to study the rules of market behavior. All right, if you look at price and how it has responded to different events in the past, you will see that it's not random. All right, it's not random at all. It's not just a shot in the dark. All right, price movement is only random to those that have not studied the rules of market behavior and how it relates to human behavior and human psychology and how we tend to manage our finances. All right. So, and still after all, empirical observation, meaning that uh, observations based on the past, how the market has performed, they show that prices do trend. All right, so you can't just say that prices today price could be rising and tomorrow it could be falling for all you know. All right, empirical observation tends to show that prices do trend until a certain point where reversal is clear, and then the market reverses, and from there it might trend again. All right, so that's the technician sort of rebuttal to a random walk theory. All right, you can't just say, oh, price random is unpredictable. You can't possibly know where it could go in the future. All right, you pit me against against a blindfolded monkey. A blindfolded monkey is probably gonna win. All right, you can't just say that. All right, what we're doing with using technical analysis is basically to figure out, all right, with which direction is price going to move in a higher probability. All right, you're playing that probability game. All right, it's a probability game. All right, so it's not random, it's not unpredictable. All right, of course it's not a foolproof method as well, but to say that technical analysis is not a foolproof method, it's not 100%. All right, if you're the king of technical analysis, you'll always get the price action correct all the time. All right, but understanding and studying market behavior does help to look at does help when you're looking at the market and you're trying to figure out, okay, where could the market be going, what could the price be moving like. Okay, so that's some of the criticisms that uh, people have against technical analysis, and how we as technical analysts tend to look at it in a different way. All right, and tend to see technical analysis as being very useful. All right, it's not a foolproof method. It's not definitely not a silver bullet. All right, you use technical analysis and you can definitely get the price right all the time. All right, if there's no such method like that. All right, but technical analysis still remains a very useful skill to have. All right, when you're looking at the markets. All right, definitely a skill that you want to have. Okay. All right, so we're coming to the near the end of the webinar. All right, I'll be going through the Dow theory. And what is the Dow theory? All right, to understand the Dow theory, you got to understand its founder, right? So I'm going to give you guys a bit of backstory of how the Dow theory was formed, all right, and how the Dow theory came about. It's basically from this guy called Mr. Charles Henry Dow, all right? Mr. Charles Henry Dow is the so-called godfather of technical analysis. He was an American journalist. He founded Dow Jones and Company with Edward Jones and Charles Bergström in 1882, all right, long time ago. All right, so Mr. Charles Dow, he's termed as the godfather of technical analysis. All right, Mr. Dow also founded the Wall Street Journal, all right, one of the most respected financial publications in the world. All right, you still probably see it around now, the Wall Street Journal. And if the name Dow sounds very, very familiar to you guys, yes, all right, he also invented the Dow Jones Industrial Average, or the DJIA, all right, the DJ30, all right, as part of his research into market movements. All right, very popular in index that's looked at as a sort of a barometer of how the US economy is doing. Okay, so what he did, all right, and how Dow theory came about, he basically developed principles for analyzing market behavior through looking at price, all right, which later became known as Dow theory, named after him, and it is the groundwork for technical analysis, what TA is built upon, and it laid the foundations for what would later become modern technical analysis. So following his death, these people, William Peter Hamilton, Robert Rea, and E. George Schaefer, organized, and they collectively represented the Dow theory based on his editorials. All right, Mr. Dow never used the term Dow theory, and he never presented it as a trading system, but these were the people that sort of organized it for people to look at the Dow theory as a way of looking at how an analysis of market movements. All right, how does the market move and how does price move? All right, so the 6 basic tenets or principles were summarized by these 3. All right, and we're going to go through the 6 basic tenets of Dow theory. All right, sounds very complicated, all right, but it's generally quite simple, all right, and it's generally very close. All right, it's very close in theory to what we've spoken about earlier on the principles of technical analysis. Because remember, technical analysis is built upon from Dow theory. Okay, so let's take a look at tenet number 1. The market has 3 movements. We've seen this before, right? We've seen this before. All right, the market tends to have 3 movements. All right, the main movement, it lasts for more than a year. This is the movement number 1. All right, the main movement tends to last for more than a year, possibly several years, can be bullish or bearish. All right, you can see it on the weekly, the monthly charts. All right, it represents the broad underlying trend of the market. So broadly, is this market bullish or bearish? All right, that is the main movement. All right, it can last for a really, really long time, and you'll see it on like weekly charts and monthly charts. Okay, there's also the secondary movements or the intermediate movements that represents corrections in the primary trend. All right, it usually lasts between 3 weeks to 6 months. All right, so if you're looking on the weekly and you see a bullish trend, all right, the zigzag pattern upwards, the higher highs and higher lows, all right, those smaller pullbacks to the downside will be your secondary movements. All right, the secondary movement, it tends to last 3 weeks to about 6 months. It usually retraces between about 33% to 66% of the previous move. All right, and the third movement, all right, the smaller movement is the minor movement that tends to last less than 3 to 4 weeks. All right, and that's when you zoom in even closer into that smaller retracement, and you see it on like the hourly chart. All right, these kind of H1, H4 charts, you can see these minor movements. All right, they represent corrections in the secondary movement. So the secondary movement is a correction of the main movement, and the minor movement does the same for the secondary movement. All right, so these are the 3 movements in the market that Mr. Dow has shown in his Dow theory. Okay, market has 3 movements. All right, the second tenet is that the market has 3 phases. Right, there are 3 phases to both primary or bull markets or bear markets. All right, the first phase is the accumulation phase. All right, the accumulation phase. In this phase, what we're looking at in the accumulation phase is that the smart money, all right, like insurances, big investment funds or banks, they tend to come in and accumulate stocks at a lower price because they see that it has potential to move higher. All right, these big players, the smart money comes in, all right, and they want to try to accumulate as much stock at a lower price, all right, the lowest price at the market bottom. Okay, so this is the accumulation phase. Smart money coming in and they are trying to accumulate as much of the asset as possible because it's at that lower price before the main market movement happens. All right, the second phase is called the public participation phase, and it is a phase that you can see the largest move in prices. So you see this massive bullish trend upwards. All right, imagine this is on a monthly or a weekly time frame. All right, this is a lot of a really, really strong bullish movement. All right, this is the public participation phase. All right, it's considered the easiest phase to make money. All right, so if you're in the public participation phase, let's say you identify, okay, the second phase has started, you just buy in and you hold. All right, you hold all the way up. All right, it's pretty easy to make money. All right, you don't need to really think much. And if you can identify this phase, all right, you just follow the trend because, of course, the trend is your friend, right? So once you get in, it's really easy to make money because the price is moving in that direction. You are following the main market movement that we were talking about in the previous slide. Okay, so this is the public participation phase. All right, participation is broad. All trend followers, all professionals begin to participate, whether it's sort of retail traders or you're looking at smaller hedge funds or smaller funds. All right, they tend to come in this phase to ride the trend upwards. All right, the third and the final stage is the distribution phase. All right, the public is fully involved in the market. However, the smart money, all right, the smart money, remember at the start when they were accumulating all those assets, those stocks at the bottom, all right, they realized that the business conditions are not quite as good. All right, price is probably reaching a top. all right, it's at a ceiling, all right, so they tend to start to sell stocks and they tend to distribute their holdings to the public, who are now willing buyers, all right. If you're at the top and there's no reason to see why price could reverse, right? You might think of buying more. However, the smart money, all right, they have more information, they have more control over the supply and demand in the market. All right, they decide that okay, it's probably time to start selling. All right, they would try to distribute all their holdings at that higher price. All right, they want to sell off at the higher price, all right, to make that profit. All right, that tends to trigger that last phase, the distribution phase. Once the smart money sells, all right, once the smart money gets rid of closes all their positions at the desirable price, which is that higher price. They don't want to be selling on the way down. All right, once the distribution phase has ended, price starts to tank again. All right, so that's the three phases that the market tends to go through: accumulation, and then the public participation phase where the main trend is going in, and then the distribution phase. Okay, so that's the three phases that the Dow theory talks about. All right, the third thing is that the averages discount everything, and what it assumes, all right, this assumption indicates that everything that the market basically reflects all the available information. Everything there is to know, everything there is already reflected through the price. All right, this must sound very familiar to you guys. All right, it sounds very familiar to what I was talking about earlier. All right, price action discounts everything. All right, price action is king. So prices reflect all the hopes, the fears, all right, the expectations, the greed and fear in the market participants, all right, and interest rate movements, all right, whether it's all these fundamentals, all right, interest rate reports, earnings expectations, all these different fundamentals that could affect price, all right, they're already priced into the market. So the averages have already discounted everything. You just need to look at price, okay? And fourth, the averages must confirm each other. Right, the averages must confirm each other, and this principle specifies that in order for a primary trend signal to be valid, all averages must confirm each other. So, for example, you're looking at the Nasdaq, the Dow Jones, the S&P 500. All right, if one average records a new high or new low, then the other should follow for the signal to be considered valid. All right, so if the Nasdaq is making a new high, right, the Dow Jones should be making a new high as well, and then so on for the S&P 500 for the signal to be valid. All right, so the averages must confirm each other. Okay, and fifth, right, volume must confirm the trend. Right, trading volume should confirm the trend. Right, so volume should always increase and become heavier in the direction of a trend. So, for example, assume that in an uptrend, if you're in an uptrend and price is moving up, all right, volume should increase as price moves higher. All right, lots of people should be getting into the market to trade in the direction of that trend, and that's why volume should be increasing as prices move higher and decreasing as prices drop. All right, so in the small pullbacks, all right, the volume should be dropping. All right, and then when the main market movement happens, the bullish move happens, all right, the volume should be increasing because people are getting into the market. All right, so it's the same for the downtrend. All right, a downtrend volume should be increasing as prices fall. All right, because that's the main movement, right? The main movement is that bearish push to the downside. All right, and every time it makes a small retracement to the upside, volume should be decreasing. All right, volume should be decreasing. Okay, so you can see in the small bars at the bottom there, all right, when it was in the uptrend on the left side of the chart, every time market makes a movement in the proper so-called proper direction in the bullish movement, all right, the bullish movement tends to see the volume increase. All right, you see the small little bars increasing, that's volume increasing. Every time it makes a small pullback, all right, the volume is decreasing. All right, so that's what we mean when we say volume must confirm the trend in order for the trend to be valid. Okay. So number 6, it is that a trend is more likely to continue than to reverse. Okay, a trend is assumed to be in effect until it has reversed. All right, that's where we get the trend is your friend. All right, very popular saying. Okay, and you should always never go against the trend. All right, so if you follow trends, all right, you follow the main market movement, over different time frames, all right, traders can increase their profit making opportunities, all right, because you don't want to go against the bigger players in the market, all right. You don't want to go against the trend which shows the direction that the bigger players in the market are moving in. So if it's in a bullish trend, you want to try and trade the bullish movement, buy at the smaller retracements and then ride the move up, right? And the flip side is right for the bearish movement as well. Okay, so let's compare. All right, now that I've done both fundamentals and technicals, all right, both webinars, let's compare the technical approach with the fundamental approach. All right, fundamental analysis. All right, I've spoken about this before. You study the factors that affect the economy, and then you try and find the intrinsic value of that asset class. All right, so you analyze things like interest rates. All right, you look at employment, politics, and all that. All right, macro analysis, and the analysis of this, you could be at a micro level, you're looking at a specific company, or if you're looking at a macro level, you're looking at factors that affect the economy, so like interest rates and employment and all that. So fundamentalists will look at if the intrinsic value, so intrinsic value is really important. If the intrinsic value is under the current market price, then it's overpriced, it should be sold. All right, whereas technicals, all right, let's look at the fundamentalist side first. All right, so if its price is lower than the intrinsic value, then fundamentalists will buy. Okay, something wrong with my slides. Okay, you can see there, fundamentalists get in. All right, so when the price exceeds the intrinsic value, all right, it's overpriced, fundamentalists want to sell. Okay, so you can see how fundamentalists will react to price patterns. All right, so technicians only buy after a reversal on the way up. So technicians will buy after the reversal has happened and they want to ride that trend upwards. Okay, so there are different approaches that fundamentalists and technicians look at the markets. All right, so technicians buy after reversal, they sell after reversal. All right, so technicals and fundamentals, when we study the markets, we realize that it is only at the critical turning points, meaning the big reversals of the market, where technicians and fundamentalists tend to disagree. All right, they tend to disagree. All right, usually fundamentalists cannot explain the factors behind new market movements at the beginning of an important market trend, meaning after a reversal has happened. All right, fundamentalists, there's a lag time before they can say, okay, this is why market has reversed. All right, it's safe to get in now. All right, by that time it's probably a little late. All right, so that's why for a technician who looks at price action and believes that price has already factored in all these fundamentals, the hidden fundamentals that might be released a little too late for fundamentalists to look at. All right, they look at price action, they will be trying to get in slightly earlier. Right, so it is observed that major bull and bear markets, all right, they begin with little or no change in fundamentals. All right, nothing really happens. All right, and then a reversal occurs, and it is only after the reversal has happened and we are in that major market movement that we are able to understand why. When we look back and we look at the fundamentals, that we understand why. All right, so that's where technical analysis could be useful. All right, since fundamentals are directly discounted, it is one important part of technical analysis. All right, it's already discounted in price. Then what a technician would say is that studying fundamentals is unnecessary. All right, and chart reading is basically a shortcut. You're just looking at price because you know that price has discounted everything. However, they will also say the opposite is not true, because fundamentalists, it does not include a study of price action. All right, and even if fundamental analysis is employed, all right, the timing of when to get in and get out, all right, the entry and exit has to rely on technical principles. All right, so when both approaches disagree, you like to use technical analysis because you want to look at the big reversals and how it has happened in the past and how it could happen in the future. Right, so that's how a technician would try and argue his point. All right, but for me, technical analysis is important. You look at a reversal, all right, you look at a reversal pattern, all that is important, all right, to have a good solid base to use technical analysis. But of course, fundamentals are also important. All right, I look at fundamentals as big shakers in the market. All right, so high impact news. All right, fundamental factors that will affect the price of a particular asset class. It tends to uh, have a big swing on the market. So, for example, like I spoke before on the non-farm payrolls, all right, we know that it is a big shaker in the market. It's a big high impact news. All right, you can expect that indeed there's going to be a bigger market movement during that time. All right, lots of people are looking at the news and then they will be looking to react accordingly. All right, so fundamentals is important. If you just look at technicals, all right, and you discount everything, all right, you discount everything on the fundamental side of things, you might get whipsawed, right? You might just get whipsawed, stopped out, and price moves in your direction, and you don't even know why, all right? And if you were to look on the fundamental side of things, all right, take into account what's happening that could be affecting the fundamental factors in the economy, you have a better idea, all right? You could possibly decide you want to avoid trading at this time because there are some big high impact news coming, all right, or if you have a possible opinion or a bias for a certain pair, but you see that it doesn't line up with your bias on that economy. Say, for example, you're bearish on the euro dollar, but then you look at the European economy and it's doing well. It doesn't really make sense. All right. So fundamentals are a way for you to reassess, all right, reorganize, and take a look at your setups and your positions. All right. It's still a very useful skill. All right, but technical analysis is equally as useful as well, right? Studying price action and seeing how it has played out in the market before and how it could play out, all right, it's still very important. So I like to use more of a mix instead of just solely looking at something, all right? Like I said before, technical analysis is not a silver bullet, all right? You just use it and it definitely works all the time, all right? But the same can be said about fundamental analysis, all right? So you want to look at both of them equally, all right, and you wanna take into account both forms of analysis when you're looking at the markets. Okay, so that's all I have for you guys on today's webinar on technical analysis. All right, it's a good wrap up to the two-part series on trading. There's a fundamental analyst approach and the technical analyst approach. Right. So if you guys have any questions, all right, a bit overshot on the time here, but if you guys have any question, just drop it in the questions tab. All right, we'll just give maybe about 1-2 minutes, see if there's any questions.